Welcome back to the Bank of Korea Economic Outlook. I am Bo-min, and joining me today is my colleague Seung-min. In this episode, we'll walk you through our February 2026 forecast, covering the global backdrop, the domestic outlook, and the key risks around it. There's quite a lot to unpack, so let's get started.
Great to be here. The headline this time is cautiously positive. We've upgraded our growth forecast for this year, which is an encouraging shift. Let's dig in.
Let's start with the global picture. Overall, we expect the global economy to sustain solid growth this year, despite headwinds from US tariffs. Two key tailwinds are at play: the ongoing AI-driven investment boom and accommodative monetary and fiscal policies around major economies. Starting with the US, growth remains robust, supported by AI-related capital spending and policy support. For the euro area, the story is more nuanced. US tariffs are weighing on trade, but that's being offset by easing financial conditions and a significant ramp-up in fiscal spending. So we see a modest growth continuing there. Not spectacular, but steady.
And then there's China, which is more of a mixed story. The property downturn and weak domestic demand persists, and export momentum is fading. But China is doing what it can, diversifying trade partners and employing targeted stimulus measures. So we're not looking at a hot landing. On the global trade, growth is likely to moderate as tariff effects become more tangible and uncertainty lingers. However, AI-related trade flows remain a bright spot, and new trade agreements like the EU-India FTA should help limit the deceleration. Where things get really interesting for Korea is the semiconductor cycle. The AI boom is evolving. We're moving beyond model training into inference and real-world deployment, and that's generating very strong demand for memory chips. The upcycle is firmly intact.
It is, but the uncertainty around it is enormous, and I want to stress that. On the optimistic side, think physical AI, robotics, sovereign AI programs. All of these could push chip demand well beyond current expectations. On the downside, a pullback in AI investment or US tariff measures targeting semiconductors could significantly dampen the outlook. We'll come back to this in our scenario analysis later.
And a quick word on oil. Brent crude has risen on elevated US-Iran tensions recently. But we expect prices to drift lower over the course of the year as the global supply surplus persists.
So overall, the global backdrop is broadly supportive, but with some very large question marks, especially around semiconductors and trade policy.
Before we get into the domestic forecast, let me quickly lay out our tariff assumptions since they underpin a lot of what follows. In short, we assume current tariff rates on Korean goods stay where they are, even though US reciprocal tariffs have been invalidated and replaced by a temporary 15% global tariff, given similar product coverage. We assume product-specific tariffs remain in place, including the auto tariff and a higher rate on steel.
The one change worth flagging is on semiconductors. We'd originally assumed the chip tariff could hit around mid-year, but we've pushed that back to early 2027. The uncertainty is just too high, and the inflationary cost for US tech firms makes near-term action less likely. That deferral is one of the factors behind our upgraded growth forecast, which brings us to the domestic outlook. So now to the core of it, Korea's growth outlook. We're projecting GDP growth of 2% for 2026, an upward revision of 0.2 percentage points from November. So what's behind this upgrade? The semiconductor upcycle is stronger than we'd anticipated. That alone accounts for about 0.2 percentage points. The global economy is outperforming expectations. The delayed semiconductor tariff assumption adds a touch, and government support measures for consumption and investment are contributing as well. In terms of the quarterly profile, the first quarter looks particularly strong. We're expecting about 0.9%. This reflects continued recovery in consumer spending, surging semiconductor exports, and a base effect from the last quarter's contraction. From the second quarter onward, the recovery should broaden as income conditions improve and AI-related exports stays firm.
Let me fill in the picture on the expenditure side. Private consumption is expected to grow 1.8% this year, supported by improving income conditions and recovering consumer sentiment. The Consumer Sentiment Index came in at around 111 at the start of this year, which is a solid reading. Facilities investment should post steady gains up 2.4%, largely driven by semiconductor capacity expansion and broader AI-related capex. And goods exports, we're projecting 2.1% growth, moderated from last year as the base effect fades, but still underpinned by strong semiconductor shipments.
The one area that's still clearly lagging is construction investment. After contracting nearly 10% last year, we're only expecting a modest 1% rebound in 2026. The non-IT sector more broadly, construction, and parts of traditional manufacturing remains weak. That's why we've been describing this recovery as K-shaped. The IT sector is powering ahead, while the rest of the economy is struggling to keep up. This divergence is one of the defining features of the current cycle.
On the external balance, the current account surplus is projected to reach $117 billion this year, significantly above our previous forecast. That's largely thanks to surging semiconductor prices and stable energy costs on the import side. The goods balance should widen considerably, although the services deficit is also expected to grow on higher digital service spending, think platform subscriptions, and rising industrial royalty payments.
Now turning to inflation, we're forecasting headline CPI inflation of 2.2% for 2026, a slight upward revision of 0.1 percentage point from November. Core inflation is projected at 2.1%.
The key context here is that demand-side pressures remain limited. The output gap is still in a negative territory, and the K-shaped recovery means strength in IT isn't fully translating into broad-based price pressures. What's nudging inflation slightly higher are cost-push factors, electronic prices, insurance premiums, and similar supply-side elements. In terms of the trajectory, January CPI came in at 2%, down from 2.3% in December, as high base effects on energy prices kicked in and favorable weather eased food costs. We expect inflation to hover near the 2% mark through this year, before settling right at target in 2027.
One point worth noting, we've done some analytical work this round on how the divergence between sectors is affecting inflation dynamics. In a K-shaped recovery, the Phillips curve relationship between output and prices can behave differently than in a broad-based expansion. Concentrated strength in semiconductors, for instance, doesn't generate the same kind of generalized wage and price pressures you'd see from a more balanced upturn. That's one reason we think inflation will remain relatively well contained despite the decent headline growth number.
On the employment front, total employment gains are expected to come in at around 170,000 this year. The moderation reflects structural headwinds, such as the continued decline in the working age population. However, private sector employment conditions are expected to improve gradually as services sector conditions strengthen, supported by a recovery in consumption and continued growth in inbound tourism. There are two-sided risks here as well. Government's youth employment initiative could provide an upside surprise, while restructuring pressures in certain industries remain a downside concern.
Let's close with the risk assessment. The growth outlook is surrounded by significant uncertainty, and I want to highlight the scenario analysis we have conducted on the most consequential risk factor, semiconductors. In the optimistic scenario, where physical AI takes off and semiconductor export volumes stay near last year's elevated pace, GDP growth could be 0.2 percentage points higher this year, with inflation also edging up by 0.1 points. In the pessimistic scenario, where AI profitability disappoints and bottlenecks like power shortages intensify, growth could be 0.2 percentage points lower this year, with inflation down by 0.1.
Beyond this risk, it's worth noting the financial market dimension. Markets are caught between optimism about AI's long-term growth potential and concerns about overinvestment. We're also seeing renewed nervousness about fiscal sustainability in some major economies, which could trigger bouts of volatility in global capital markets.
To sum up, we're projecting 2% GDP growth and 2.2% CPI inflation for Korea in 2026. The upgrade from November is encouraging, driven mainly by the semiconductor tailwind, but the recovery remains uneven across sectors.
The K-shaped nature of this recovery is really the through line. The headline numbers look solid, but beneath the surface, the divergence between IT and non-IT sectors has real implications for jobs, for inflation, for income distribution, and ultimately for the policy path ahead. That's something we'll be tracking very closely in the months to come.
Well said. That's our February outlook. For further details, please refer to the Bank of Korea's Korea Economic Outlook. Thank you for watching, and we'll see you next time.